Welcome back, and in your business news, the UAE, Qatar, Kuwait and Bahrain are among the top 10 countries in the world by proportion of millionaire households, according to a recent study by Boston Consulting Group. According to BCG's report, The Battle to Regain Strength, Global Wealth 2012, private financial wealth in the Middle East and Africa grew 4.7% to $4.5 trillion in 2011, up from $4.3 trillion in 2010. Furthermore, it is expected to grow by a compound annual growth rate of 6.6% by 2016 to reach $6.1 trillion, largely as a result of continued strong GDP expansion in oil-rich countries. The BCG study also estimates that between 2011 and 2016, private financial wealth in the region will grow by a compound annual growth rate of 8% for households worth more than $100 million, 8% for households worth between $1 to $100 million, and 5% for households worth less than $1 million. As a regional offshore financial center, Dubai held assets worth $0.2 trillion, with Saudi Arabia, Kuwait, India, Iran, as well as Turkey as the top 5 sources of offshore wealth. Jet has launched its first scheduled flights and said it plans to expand its services across the UAE, according to local reports. The Abu Dhabi-based domestic carrier has started flying 50-seat planes from Al Bateen Airport in the capital to Surbanias Island. Jet, which is not affiliated with the hotel brand, now plans to fly to Ras Al Khaimah and Fujairah, while flights between Abu Dhabi and Dubai are currently under consideration. According to a local daily, Rajendran Valapalath, the director of Commercial and Planning at Jet, has said that the company is now exploring opportunities, especially from places like the Northern Emirates. The Abu Dhabi market index gained 0.2% today as oil prices recovered in line with global speculations of a concerted stimulus for the indebted Eurozone. Leasing specialist Waha Capital jumped 5.5%. Market bellwether Etisalat added 0.34% to hit a one-month high, while merger candidates Aldar Properties and Saru Real Estate added 0.91% and 1.96% respectively. So with that, let's now take a closer look at the stock indices across the GCC. U.S. stocks jumped on Wednesday, with the S&P staging a major reversal above its 200-day moving average as talk of a rescue of Spain's troubled banks and hopes for more monetary stimulus sparked a rebound from recent selling. To talk about this and the implications of today's briefing on Capitol Hill by U.S. Fed Chairman Ben Bernanke, we earlier spoke to Bruce Powers, Head of Research at Trust Securities.
Well, we saw a disappointing employment number on Friday, and that really started speculation in the markets that the Federal Reserve could announce further stimulus, or QE3, to help the U.S. economic recovery. Gold responded with a sharp rally as further easing is seen as bullish for gold. The dollar has been easing, and U.S. stocks have been moving higher this week. Talk of a rescue for Spain's banks and other European banks added fuel to the speculation. Yesterday's close above the 200 moving average is an important bullish sign, but we'll have to see if the S&P index can now stay above it and go higher. The market will be looking for some sign from Mr. Bernanke to confirm that the Fed is ready to move and that they feel more stimulus is needed to help the U.S. economic recovery. If his testimony gives the impression that they are not ready to act and remains in a wait-and-see mode, which was indicated in the statements in April, then we could see a reversal in U.S. equities and gold this week and a turn back up for the dollar. He did say in April that they provide more easing if unemployment fails to make sufficient progress towards a long-term normal level. So that seems to be the reason for the strong reaction to Friday's report. But I think right now market expectations may be a little too high. Yes, the U.S. economy is showing signs of slowing, but yesterday's Beige Book business survey showed that the U.S. economy is maintaining a moderate pace of growth. And there's been some improvement in manufacturing and real estate. So far, if we look at the U.S. equity, we've seen a normal decline off the high. the S&P 500 benchmark is only corrected 11% from the high that was reached in April.